So hi again, folks. We've had many conversations over the last few weeks, especially with the immersion of the COVID-19 pandemic and the effect that it's had on markets in negative aspects. And so what is important for us to do is we have to circle back and clarify and re-emphasize 5 of the top mistakes that we see in the instinct of prospective clients and even in our own clients on just how they approach investing. And so what we want to do is outline exactly what these 5 biggest mistakes are. Number 1, do not sit in cash. The only time that you should ever sit in cash is if you are planning a major purchase or an expenditure or a consumption item. But if you are investing, unless it is very, very, very short-term in nature, you should never sit in cash. Because investing in cash, you are virtually guaranteeing that you will lose money to inflation on an ongoing basis. Even Buffett himself is sitting on over close to $100 billion of cash coming into the pandemic, but it wasn't sitting in cash. It was sitting in long-term US Treasuries, still getting an actual return on his investment. So never sit in cash. Number 2, stop focusing on speculation. I don't know anybody that has beat the market over the long term, and I don't know anybody that knows anybody that can beat the market over the long term. It is one of the most toxic mindsets you can have when it comes to investing, is thinking that you can actually outperform an asset class just by trading securities. And yes, you might get lucky in the short term, but mark my word, if 95% or more of professional investors can't match the market or improve on that return, why would a retail investor or a common investor be able to do so? So stop speculating, because it is virtually impossible to time the market. And also, why would we want to get that perfect? Perfection is almost the mother of all evil, and it will keep people from being great with their investment strategy by trying to get too cute and too perfect with their timing. Number 3, we've preached to the choir about this for many years now. Avoid actively traded mutual funds. Once again, professional managers, 95% chance of not matching the market index. So if you are investing in mutual funds and it is not sector specific, but market based, which means they're investing in US stocks, what are the chances of that manager being able to time the buy, time the sell, know what to buy, and know what to sell relative to the overall market consistently and confidently over a long period of time? It virtually has never occurred. You know, almost a rounding error to 0, the amount of asset managers that can actually underperform the market. All the meanwhile charging you enormous fees, sometimes upwards of 2.5% to 3%, just for the luxury of investing with them and still underperforming the market. So avoid mutual funds, actively traded mutual funds, virtually at all costs. Number 4, this is probably the best thing that we hear, and best as I mean that in a sarcastic nature. I'm waiting for a better time to invest, or I'm waiting for the market to recover before investing. Now I have to always think, well, why on earth would anybody ever want to do that? Like if you lay it out, you're going to wait for a better market opportunity, or rather, not a better market opportunity, but rather a better economy or market or perception of the market before I'm going to invest. Well, what do you think is going to happen to prices? Prices will have already been escalated because the market forecasts on what's coming next. What people don't understand is you do not invest today based on the state of today's economy. You invest based on the probability or the opportunity of future economies. So for instance, on March 18th, the COVID-19 epidemic didn't really have a huge impact on the world economically at that point. And yet that was almost the low point of the market. So why is that? The market was, like clockwork, looking at the probability of what will occur in the coming months. Now, as we move through that and we get more clarity, or we get different news that comes out or different instincts from the market, they're going to forecast looking forward. Now, I'm not trying to say that where we're at today is going to be the low spot or not, But all that we have to remember is stop thinking that the market and asset prices trade on today's economy. They do not. They trade on future economies and future prospects. And number 5, this doesn't happen very often with our clients, but more for new clients that come to us and just are not used to the nature and the confidence in which we invest. So as the great Steve Jobs said, why on earth would I ever hire someone great and then tell them what to do rather than have them tell me what to do? That's why you hired them in the first place. You have to trust their conviction and their process. If you don't, it's time to find a new professional. It doesn't necessarily mean that everyone is going to be a fit, but if your beliefs and you do not lean into the strategies that your professional, whether it's a doctor or whether it's a mechanic or whether it's a lawyer or whether it's an investment manager or portfolio manager, if you do not trust that person to execute on your behalf, then you need to find a different professional. And so often we see, again, clients will expect they're going to tell their advisors how to invest money, how to deal with tax, etc., rather than ask for their input. And it doesn't mean that you shouldn't challenge them or ask great questions, but you have to trust your professional. If you feel hesitant, or if you feel like you're creeping in with speculation, or you're trying to time the market or do things that are out of the ordinary, it's time to lean into that professional, get the stewardship and the professional advice that you need and act on it. And if you can't, it's time to find a new professional. So once again, those are the 5 biggest mistakes that we see more often than not, and more specifically when markets are in turmoil or when there's enhanced volatility. The more that our clients and investors can stay away from these mindset traps, the better off they're going to be and the more prosperous they will be in the long term.